Welcome back to Stock Talks of Tuesdays. Today, I'm going to talk about how to find a good stock to invest in. Good stocks can be depicted from 5 facts: trends in earning growth, company strength relative to its peers, debt to equity ratio in line with industry norms, price earnings ratio can help provide market value, effectiveness of executive leadership. So, let's start with the first factor: trends in earning growth. Look for trends in a company's earning growth over time. Do the earnings generally increase? If so, it's a pretty good indication that the company is doing something right. Even small, regular improvement over a long period can be a positive indicator. But earnings growth and value have to go hand in hand in order for the stock to be worth the investment. Evaluating a company is a combination of understanding how the business works and how valuable its future cash flows are, says Farron Doggs, founder and CEO of Harrison Wallace Financial Group in Libertyville, Illinois. This involves evaluating its products, services, target market, and cost structure. This process allows one to determine a company's competitive advantages, market opportunity, and the sustainability of cash flows. Now let's go on to our second factor: company strength relative to its peers. Start by looking at an industry represented in the market and establish if there is a future growth potential. Industry can be a great screener when investing. However, when picking individual stocks in an industry, you need to look at where the company fits in. How does it fare against its competitors? Is there an advantage that allows it to stand out? These critical questions can help determine if a company has an edge. All companies carry debt, even Amazon.com and Apple. Investors can use debt as an indicator of the financial well-being. Watch out for companies with high debt levels relative to their equity or its debt to equity ratio. To find this number, divide the total liabilities on the company balance sheet by the total amount of shareholder equity. For those with a lower risk tolerance, that number should be 0.3 or less. The PE ratio is a valuation metric that measures how well a stock's price is doing relative to the company's earnings. When using fundamental analysis and value investing strategies, PE ratio is considered a major indicator of whether a stock is undervalued or overvalued. It gives insight into a stock market's market value or its worth according to financial markets. How much do you trust the people at the top of a company? Effective leadership promotes stable and long-lasting company culture with innovation and flexibility at its forefront. Companies that invest back in themselves develop their business growth and increase their footing in their industry. A well-managed company is often one that enjoys stock prices that trend higher. To evaluate the effectiveness of a company, John Cunnison, Vice President and Chief Investment Officer at Baker Boyer Bank, Washington, says, strong company level analysis requires that investors have an understanding of the range of possible futures in both qualitative factors and quantitative factors. Profitability, cash flow, debt levels. Through these details, investors can make observations about a company's prospects and the direction management is taking. All valuable insights in your stock picking decisions. That's all for today, my investors. I hope you understood on how to find a good stock to invest in. I hope you get huge sums of profits. Thank you for listening. Bye.